Come on board Sandip Sabharwal as well and find out how this week and today is likely to pan out. Sandeep, hi, good morning, and can't get your eyes off from HDFC Bank's quarterly update. Slower than expected business momentum. No wonder on the Friday the stock fell the way it did. What's been your reading?
Yes, so I think the course correction in HDFC Bank continues. I think they were way above the overall credit deposit ratio. And that adjustment on a systematic basis within the bank, I think, has focused more on deposits and less on advances. And that's the result of this. So I would think that with this quarter credit deposit ratio now coming into a more comfortable zone, we could potentially see growth starting to come back from HDFC Bank. Now, whether they can go back to a growth similar to the system growth given their size, like the system growth or credit growth right now is around 12%, or they'll lag behind is something we need to see. But with these numbers, it seems like the current quarterly profit numbers could be significantly below expectations, given that there'll be also margin pressure due to deposits growing much more than credit and with a decline in CASA ratio. So near term should be cautious, but if a correction of 4-5% takes place, then we could look to buy it.
Ask that whether it becomes a buy if there is a due correction from now up until the earnings. But Kunal, do you see that happening on the charts? Because HDFC Bank falling 4 to 5% would obviously have an impending reaction on the index too.
But there could be a possibility that the stock may correct, because for the first time, I think in the last 1 month or so, the stock has confirmed breakdown of its key 50-day moving average. The concern for the stock is also the swing breakdown. The stock was holding on to that 1775 odd range as a support, and 1850, 1875 was the fresh high for HDFC Bank. So the stock was trying to establish a range of 100 odd points higher than the previous breakout range of 1770 thereabouts for HDFC Bank. So with the breakdown of its major support, for HDFC Bank, there are some concerns, fresh concerns, which have originated for the stock. There have been bearish breakdown signals for the stock on the MACD as well as on the RSI front on the daily charts. That generally indicates that potentially over the next five sessions or 7 to 8 sessions, the stock may see a drop of another 3 to 5%. So there could be a possibility that HDFC Bank may correct further.
Okay, point taken. So HDFC Bank might correct further. We're talking about the Q3 update, Sandeep, and there is update coming in from Angel One as well, and they have clearly seen a decline in the month of December. We have been talking about how the F&O volumes have seen a bit of a decline already by 20 to 30%, and there are further regulations which are coming into place, the larger, order size and all of that, which might further impede the growth. Do you think for the time being the best is behind some of these brokerage and AMC companies?
Brokerage at least, because AMCs don't get affected by whatever is happening on the lot sizes, etc. So AMC performance will depend more on how the retail investment flows continue in light of the fact that over the last few months, the returns for them would be negative. So if over the next 2-3 months, the base becomes such that where year on year returns come to single digits for a majority of mutual funds, whether the retail flows continue at the same pace, redemptions pick up, etc. That's something we need to see. Uh, Structurally, the SIP flows is a strong story, but will there be SIP stoppages, etc. So a lot of positives are in AMC stock prices, but any significant fall is not expected. So there could be more a stagnation. But on the brokerages side, what you're saying is right. I think a lot of the trading activity also has to do with sentiment. Most retail investors tend to play on the long side on derivatives. So as they have not been making money over the last few months, combined with the regulatory restriction, we could see a decent cut in trading volumes for many of the brokerages from the retail side, which could impact the performance at least over the next 1 year. So I would think that these stocks should largely be an avoid.
Sandeep, I'll extend this, contra logic in Avenue Supermart versus Zomato. Now, quick commerce is getting a lot of headline. But if a business like DMart or VMart, if they are making a comeback, that means value retail in India is not dead. Could the strength in DMart also coincide with a topping out in Zomato and Swiggy?
The core business of Zomato and Swiggy still remains food delivery, and to that extent, I think that should continue to grow. However, they've been putting a lot of money into quick commerce, and there the competitive intensity is increasing with more players, free delivery over a particular order, again, a value again coming back, which would still be loss making for a majority of these quick commerce companies. So I would not correlate it to what's happening with what Avenue did in the last quarter. I would say that in general, the optimism is significantly built into the prices of Zomato at least. And we need to see how their huge investment into quick commerce and increased competitive intensity further accelerates the cash flow burn, or that doesn't happen. So I think it will be interesting to watch over the next 1 or 2 quarters. But at this stage, I would think a lot of the positives are in the price.
Sandeep, in your list, which are the ones which could move from mid cap to large cap in next 1 year?
I don't know what could move from mid cap to large cap. All these definitions have no meaning actually. From an investor standpoint,
No, for example, what I'm trying to understand is that there are trends sometimes you have to look at. For example, let's say if you said, okay, food delivery is a permanent trend, then 2 years ago, Zomato was available at a market cap of 15 billion, right? Today, look at what the market cap of Zomato is. Similarly, there are a lot of trends in solar which have become big. There are a lot of trends in defense which have become big. There are a lot of trends which have become big in manufacturing. Are there any sizable things which you see which may be small today, they may be okay in terms of their market cap appeal, but suddenly the lay of the land could change for them, the dynamics could change for them, and they could be sizable businesses?
eventually, I think anything which has to do with consumption or as the per capita income moves up, I think those will be bigger trends. A lot of the investment cycle led trends, like you said, defense, etc., they also tend to be somewhat cyclical and with a single client focus. And to that extent, uh, there are stages, as we are seeing in railways today, that suddenly the demand becomes low and the growth gets impacted. So trends keep on evolving. I think many of the new generation companies who have stood out, like you said, about food delivery, or even companies like Policy Bazaar, etc., which initially did not were not focused on profitability, then came out and said that we will focus on profitability, and the insurance landscape also is changing in their favor with a lot of regulatory possibilities coming from IRDA, etc. I think the wealth management space will continue to become bigger and bigger as the country becomes prosperous. So I think many of those companies would potentially become large cap. Like offhand, this is coming to mind.
Sandeep, quite a bit of jump after, the quarterly updates for DMart. What is your own sense on whether or not the stock has come out of the hiatus that it was? Or do you still sense that the QCOM impact is something that's going to be felt when the earnings get declared shortly?
The quick commerce impact on value retailers was in any case overhyped. So I was not a big believer in that. I think though that had more to do with what the analysts are putting out in their notes. I think value retail was getting impacted more because of a general sentiment slowdown in consumption and these companies trying to re-strategize how they were growing. And to that extent, I would think that a bottoming of this performance should create some upside for Avenue Supermarts, given the liquidity of the stock and the fact that it's still around 35% off the top. But on the flip side, the valuations are still quite high, given the fact that it's not really done much over the last few years. So you are right to that extent that now margins will become important. So if there's a margin uptick due to the strong sales growth and profitability improvement is much better than sales growth, then the stock price performance could sustain and accelerate. But if with this growth we still see margin pressure, then I think it could stall. So I think results will be out in a week or so. So we'll know.
Oh yeah, Avenue Supermarts in the last 52 weeks, a meager 6% of a move, and a large chunk of that frankly played out on Friday alone when you had the stock jump up nearly about 12% on the futures. The other segment in focus is going to be FMCG as well. Marico has come out with its quarterly numbers, and while that update is on the positive side, they've managed to deliver mid-teen year-on-year revenue growth in the third quarter. They're expecting a modest EBITDA growth. For Dabur though, the general trade is still under pressure, and the consolidated revenue growth estimate is still in low single digits. Sandeep, a mixed bag when it comes to FMCG, at least the quarterly updates so far. What is your own reading, considering you're betting on, these stocks bottoming out this year sometime?
Third quarter was expected to be slow, and to that extent, these numbers are not very surprising. But they do tend to create some negative sentiments among analysts who become very negative when things are bottoming out. So I think if this creates one final correction in many of these stocks and we get them even cheaper than what they are right now, I would be buyer. So I'm not negative on FMCG per se, because when positive data points start coming up, let's say a year from now, if these companies in the same quarter say that we grow in low teens or that kind of number, with that kind of news flow, these stocks will be much higher. So you need to buy many of these companies with strong moats and strong brands at times when their performance is under pressure.
On your buy list?
So I see value across the board in the large cap FMCG companies, like not in terms of pure value, like not as a value buyer, but as value vis-a-vis where they traded historically and how the stocks have corrected. So companies like Dabur, Tata Consumer, Godrej Consumer, HUL. So people need to take their pick what they want. I think all of them over a 1 year time frame from now should be up between 12, 15 to 20%.
Talking about companies with big moat, Maruti was the one which had a big moat for the longest time. It was the highest selling car in the country, but now that has been overtaken by Tata Punch. It's coming after 40 years that Maruti is not the top selling car in the country.
Yeah, but that doesn't matter because it just means that they have moved on. They have the crossovers, the bigger vehicles, etc., are selling much more than the smaller ones, which actually adds much more value to their growth as well as margins. So I think that's nothing to be negative about. And like we were talking about FMCG previously, like even in case of Maruti, see the stock price was correcting on negative numbers, and 1 month of positive sales data has created a 10-12% upside in the stock in a very short period of time. So I think that's the key in buying large cap companies, which already have fallen 30-35% from the top, to see where the performance could bottom out. And if you buy at that time, the downside is limited and upside could be greater.
Okay, on that note, Sandeep, we'll let you go. Thanks so much for joining us this morning, but it's time.
If you like this video, then like, share and subscribe to ET Now.